Minutes before the world changed, someone placed a bet. Not hours before, not even an hour before, minutes. And when the news finally broke, the market moved exactly in their favor. So the question really isn't what happened that morning, it's who already knew.
And this wasn't some small speculative trade. We're talking about an enormous position, $580 million, a trade that required immense capital and incredibly sophisticated execution.
And then, just 14 minutes after that trade was made, an announcement came out. An announcement that no one was supposed to see coming. It sent the markets into an absolute frenzy, and it made that $500 million bet incredibly profitable. A coincidence? Well, maybe. But to really understand it, you have to look at the context.
To understand the trade, you first have to understand the moment. This was March of 2026, and the entire world was holding its breath.
Tensions between the United States and Iran were escalating, and fast. So the market was driven by one thing: fear. The specific fear was that the Strait of Hormuz, this critical channel that carries nearly a fifth of the world's oil, could be shut down. And in the markets, war is the ultimate uncertainty.
So traders were doing what they always do in these situations. They were betting on chaos. Oil prices had already surged past $100 a barrel, and analysts were warning it could go much higher, to $150, maybe even $200 a barrel. The logic was simple. If conflict gets worse, oil becomes scarce. And scarcity means profit. That was the consensus. It was really the only logical play. But someone bet the other way. You see, when the news finally did break, the people who reacted first, they didn't really react at all. They were already prepared.
So let's zoom in on the morning of March 24th. Because between 6:49 and 6:50 a.m., something really unusual happened in the oil market.
A massive wave of trades totaling around $580 million suddenly hit the oil futures market. At the same time, other big trades were betting on the stock market going up. Then, just 14 minutes later at 7:04 a.m., Donald Trump posted something online: productive talks with Iran, de-escalation.
This one single bet went against everything the market was afraid of. While pretty much everyone else was bracing for scarcity and higher oil prices, this trade was positioned for the exact opposite outcome. It was a direct contradiction of what everyone thought was about to happen.
And instantly, the market proved that trade right. Oil prices dropped hard, over 10% in a single move. Stocks jumped. The bet had paid off perfectly.
Think about it. A massive bet, placed just minutes before a market-moving announcement. These weren't lucky guesses. This was a trade made with a kind of confidence that, well, it doesn't come from guessing. It comes from information.
Now, to understand why this is so significant, you have to understand how markets really work. They're not driven by reality. Not really. They're driven by information, and more importantly, by who gets that information first.
You can think of the market as a race. Everyone's running toward the same finish line, which is profit. But not everyone starts at the same time. Some people get to hear the starting gun early. If someone whispers the result before the race even begins, well, that's insider information.
But proving it is extremely difficult. See, information doesn't move in a straight line. It leaks. It leaks through advisors, through offhand conversations, through indirect signals and patterns. By the time the trade actually happens, it's almost impossible to trace it back to the original source.
The suspicion here is simple. Someone close to power heard the whisper. As the economist Paul Krugman put it, the most obvious explanation is that someone with confidential information used it to make a profit. And what this does is it creates a system where the people who are closest to power have this invisible advantage, not because they're any smarter, but because they are earlier. And in the markets, being early is everything. Now, regulators are looking into these trades. Questions are being asked. But so far, there's no actual proof of wrongdoing, just the timing, the scale, and the pattern. And here's why this really matters to you. Because markets are supposed to be fair. Not equal, of course, but fair. It means everyone is supposed to be playing with the same information at the same time. But if that fundamental assumption breaks down, the entire system changes. It becomes less like investing and a lot more like a game. A game where some of the players can actually see the cards. And you can't. Because your decisions, they're based on public data, theirs are based on private knowledge. And this isn't just about one oil trade. There's a growing pattern of this sort of thing. Well-timed bets right before major political events. Large, unusual trades that just happen to appear moments before key announcements. Individually, you could dismiss each one, but when you look at them together, they raise a very different kind of question.
That $580 million trade may never be fully explained. Maybe it was just an anomaly. Maybe it wasn't. But at this point, that's almost beside the point.
Because the real story here isn't about one trade. It's about a system where information is uneven, where access is invisible, and where timing is everything. And once you really understand that, you stop asking who's lucky.
You start asking, who's early? Who gets the information that moves entire markets before the rest of the world does?
And maybe more importantly, who gets to be?